SoFi reported third quarter financial results that were better than what Wall Street analysts were expecting and better than what management told investors they would deliver. They also increased the guidance for the rest of the year since the year so far has gone better than what management was expecting. This is 2 straight years now where the year has gone better than what management was expecting, and management usually for SoFi takes a more cautious approach to providing guidance. That's why many investors have come to believe that SoFi will outperform expectations they forecast. In this video, I'm going to review the company's latest earnings results, take out all the details that you need to know about if you're interested in SoFi stock, whether you own the stock or whether you're interested in buying the stock. I'll also provide you with my fair value calculation for SoFi stock using my proprietary discounted cash flow model, and I'll update my buy, hold, or sell rating on SoFi stock. I'll do all that in this short video. Let's jump right in.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
SoFi's management team is excited about the opportunity ahead, saying that the opportunity before us is massive and we're investing from a position of unparalleled strength. We're investing aggressively across the business, accelerating innovation in cryptocurrency, blockchain, and artificial intelligence, which are three of the most popular investing trends right now, with artificial intelligence being the one that I see has the most value over the long term. SoFi reported total net revenue of $961.6 million, and that was up 38% from the same quarter last year. SoFi's adjusted earnings per share increased by 120% to 11 cents a share in the most recently completed quarter. And for the 9 months, which ended September 30th, its earnings per share is up 225% from the same 9-month period last year. SoFi is growing its revenue, adding new members, investing aggressively in the business while still increasing earnings per share. It's really performing excellently, and it's one of the reasons coming into this year I rated SoFi stock as a buy. I had it rated as a buy all the way up until it was up 85% year to date, and then I downgraded the stock to a hold because I felt the valuation was getting stretched, and I felt a lot of the upside was already priced into SoFi stock. Coming into the quarterly earnings release, I did a preview video, and I told investors I didn't think there was any reason to buy SoFi stock ahead of earnings. And these earnings results validated my belief that it wasn't a reason to buy before earnings because SoFi delivered what I saw, and I've gone through the entire report, what I saw as an absolutely excellent quarter. And despite delivering an excellent quarter and increasing guidance for the rest of the year, SoFi stock price was volatile. It was down 3% at one point. Before I started this recording, the stock was up about 1.2%, despite delivering an absolutely excellent quarter. So imagine what would have happened to the stock price if there was something off about the quarter, if Wall Street didn't like the guidance, or if Wall Street didn't like some of the numbers about its loan defaults. Imagine what would have happened to the stock price, right? So that's why valuation is an important concern for investors. And when a stock price is already up by so much heading into earnings, and when the valuation is so stretched, there's limited upside following an earnings release, while there's huge downside if the company raises any question marks that could threaten that huge rally that it's undertaking. As I mentioned, it was a great performance, record numbers of members added. 905,000 new members joined SoFi in the quarter. That was up 35% from 12.6 to 12.6 million. And this is one of the reasons why I've been so bullish on SoFi over the previous, I want to say, year and a half or so. It's because people prefer online banking nowadays, and that preference is expanding because brick and mortar branches are not investing sufficiently in that brick and mortar advantage. Typically, having all of those physical locations inside communities where people can walk in and experience your company, experience your staff members, that would be a huge disadvantage for SoFi to overcome. But since these brick and mortar branches have been stepping back and cutting staff, not training them properly, only having basic services offered inside these branches, that brick and mortar presence has become less of an advantage for these legacy banks, and it's becoming more so. Instead of leaning into it, these banks are stepping away, reducing staff, cutting costs, and not really taking advantage of that. And that's worked right into SoFi's hands. The strategy is now allowing SoFi to gain so many members because as a digital only business, they're able to invest their capital into areas where people like, instead of brick and mortar companies where they're investing and maintaining these branches, utilizing capital for something that people are not really interested in experiencing. So during the quarter, SoFi had a few innovations, including Cash Coach. They introduced level 1 options. This is for investors looking to trade options. And they expanded access to alternative investments and increasing the benefits of SoFi Plus. Now, here's the category that's generating the most in terms of growth for SoFi, unexpected growth for SoFi, and it's the loan platform business. This segment originated $3.4 billion in loans on behalf of third parties in the third quarter and generated $168 million in revenue. That was up 29% from the previous quarter, and it was up 2.75x from the same quarter last year. Now, I've been talking about this segment and how lenders have grown increasing interest in buying these loans originated by companies like SoFi and even Upstart. This is where SoFi will originate the loan. They will do all the due diligence, the customer acquisition, etc. And then once they originate the loan and it's finalized, they will sell it to this lender who will purchase the loan and assume the risk of default if there should be default. SoFi in some cases will continue servicing the loan, meaning customers will keep paying SoFi, but they're doing the collection on behalf of that third party. And of course, SoFi earns a fee for that service also. It's a high margin, high profit business with lower risk than the previous loan business, which is originating loans and keeping it on your balance sheet and collecting payments from customers. And if a customer defaults, then that's on you. You lose the money. But when you sell it to a third party, the third party assumes the risk. Now, the appetite from third parties is growing significantly, as you see here, because these loans can generate 13, 14, 15% interest income, right? And so when you compare that with the 10-year government bond, which is paying less than 4%, lenders are increasingly interested in earning that higher rate of return. And SoFi is very much interested in providing this service for third parties because SoFi already has a large percentage of personal loans on its balance sheet. It is not really interested in increasing that. And that brings us to the next point. Personal loan originations reached an all-time high of 7.5 billion for SoFi. But what was good is student loan originations increased by 58% to 1.5 billion, and home lending increased to 945 million in originations, including 352 million in home equity loans. The home lending and student loan business is less risky than the personal loan business. Personal loans are the riskiest loans you can make, and SoFi already has a large percentage of overall loans allocated to personal loans. So diversifying away from that lowers the riskiness of SoFi, which makes it a more attractive stock. Speaking of the riskiness of personal loans, the on-balance sheet 90-day delinquency rate for personal loans and student loans remained consistent with the prior quarter, increasing just 1 basis point in the third quarter. This is something I'm watching closely as the economy in the United States is slowing down. Job growth is slowing down. Layoffs are increasing. Just this morning, UPS announced it's laying off thousands of individuals. Yesterday, Amazon announced it was laying off roughly 35,000 employees. Last week, we saw announcements of layoffs coming from Target that could reach 2,000 individuals. So layoffs are increasing now that the U.S. economy is slowing down, hindered by the expansion of trade barriers and the increase in tariffs. If you increase tariffs, you make it more difficult for U.S. businesses to import products, and a lot of U.S. businesses are based on the foundation of importing products from outside the United States. So these businesses expect less activity, less units being purchased, and if you're selling less units, you don't need as many people making deliveries, you don't need as many people processing orders, you don't need as many people to hire other people, so your human resources department can be smaller, your accounts payable, accounts receivables team can be smaller, etc., etc. And so layoffs are increasing. And so this is a category when people start losing their jobs. Personal loans is among one of the first things that people will default on. So I'm watching this closely for SoFi. This next quarter and the one after that will be huge with the government's shutdown and the impacts of tariffs really taking hold. I want to watch this segment closely as I'm seeing defaults increasing from reports from other financial institutions. Looking ahead, SoFi increased the revenue target for the rest of this year, 165 million higher than the guidance of 3.4 billion. It now expects 3.54 billion, and it now expects adjusted EBITDA of 1.035 billion, up from 960 million. It now also expects adjusted EPS of 37 cents a share, above the prior guidance of 31 cents a share. So across the board, just an excellent quarter from SoFi. So it's surprising, well, not surprising for me, but it might be surprising for you to see that the stock price has been volatile after this kind of earnings release and up only 1% as it was when I started recording this video. And the reason for that I talked about in the preview video. SoFi was already trading at a super expensive valuation. It's trading at a forward, well, super expensive according to its historical average. SoFi is trading at a forward price to earnings of 67, which is the highest it's been, near the highest it's been going all the way back to January of 2024. So I forecasted that with this kind of valuation going in, SoFi, the upside for SoFi stock after earnings was limited, but the downside was great. Because imagine if they, like I said, delivered something that was less than spectacular, where the stock price would have gone. So looking at my intrinsic value calculation, I value this business around $19 a share, and the current market price is 30, as it's up 1.3% now following the earnings release that was announced this morning. So it's an excellent business. It's going in the right direction, but the valuation is still too expensive for me. I'm going to keep this stock rated as a hold for now, waiting for a better opportunity to get in at a lower price. By the way, did you know about our exciting channel membership program? You get so much for less than $5 a month, including dozens of exclusive videos, access to exclusive research on over 100 stocks, and early access to many of my videos before everyone else sees them. Click that join button below to learn what this program is all about.